Today, folks, it is about time I update you on my $190,000 stock portfolio, which I've been investing about $14,000 just over the last 2 weeks. Extremely aggressive buying because I believe we found the bottom of the market. We are not going to be revisiting the 2022 lows. As negative as media has been over the last couple quarters, you can't help but recognize a few things. First and foremost, earnings this quarter are starting to come back aggressively across companies from every sector. Realistically, the interest rate hike cycle is coming to its end as inflation is starting to cool down more aggressively than anybody really could have anticipated, and that leads into what could potentially and looks like is going to be the first soft landing we've basically ever seen in one of these kind of market cycles. So you can't help but not want to be in this market, and I believe more and more people will start to chase with the insane amount of cash people have been piling into obviously high interest savings accounts and GICs, and they're going to get the FOMO, the fear of missing out, as the market starts to truly recover. And I wouldn't be surprised if we start revisiting all-time highs. Now, we are not out of this crazy tumultuous market just yet because interest rates are still going to bake into some sectors, but the broad view is looking a lot better than it has been, especially coming into the beginning of this year. So let's get into the portfolio, and if this is a conversation you'd appreciate, as always, hit that like button, folks, because I am always a glass half full kind of guy, because remember, bulls win and bears get sent to slaughter inevitably over the long term, and I am not a guy trying to time the market by any metric. I was just trying to patiently wait till the end of the year to top up my tax-free savings account after liquidating it to purchase a piece of real estate, which I got a lot of flack for, buying real estate in one of the worst market environments imaginable. But something tells me I'm going to greatly appreciate these decisions in the coming 5 to 10 years. So instead of just stacking cash like I was, really hoping the market was going to sustain into the end of the year, I don't trust the market because I understand that we can get these wicked movements to the upside, and that's where the real gains are made. They typically happen in very short periods, and you need to be in the market for those moments. So that's why I decided to take half the cash I wanted to invest, and I just put it in the market pretty much right away. I've still got about another 5 to 10,000 that I do want to put in the market, but I'll do that at the end of the year when I make the transition from some capital in my corporate account to my regular account, where I will have to pay some extended taxes, and that'll thus go into my TFSA. But taking a look at the portfolio before the market pullback today, we were sitting on, for the what feels like the first time in forever, about $7,000 worth of gains. Really nice to see, with the portfolio value of invested capital at $171,000 and about $19,500 in cash still on the sidelines. I am very grateful to be in the position I am, also collecting about $4,500 in dividends, but you also have to tap on the fact that I've received about $7,000 in dividends this year, which brings us to about $14,000 in collective returns. And a lot of these are in tax advantage accounts. I'm not really too concerned about the taxation on the dividends themselves. It'd be nice to get the total yield up to around 3%, which I'm hoping I can do by continuing to buy a lot more VDY, which I am lacking in. As many of you know, I did sell out of a lot of my position in VDY from the corporate account to save some taxes, and then I basically converted the VDY shares over into the S&P 500, which I'm very thankful for making that decision, because the S&P has definitely outperformed VDY since. But again, I am looking to get back into it to start collecting some nice tax-free income within that TFSA. But getting to the portfolio side and what I want to do moving forward, as we can see, because I did end up investing, that 14,000, a good chunk of that, probably about 2,000 or 3,000, went into the S&P 500, plus the gains ended up scaling it up to over 50% of the portfolio, or about a $95,000 Canadian valued position. I did put about 10,000 over the last 2 weeks, as you know, into VDY, which I actually bought another $1,000 or 1,000 or 2,000 worth just this week, taking it up to about 5.8% of the portfolio. And I've only been letting SCHD re-drip into itself because I don't have access to putting more capital in my registered retirement savings plan. I'm just letting this thing kind of cordially do its own thing, and it's been doing the portfolio pretty greatly, returning some of the losses, because I think I was down about 5 or 6%. Now I'm down only 3 or 4%, as it is pulling back a bit today as well. But I'm very happy to be in the position that I am, and moving forward, I do want to get the S&P up to about 100,000 CAD value. It'd be nice to just get a 6-figure position within that ETF. And then finally, when I start positioning things into the tax-free savings account, I am looking at buying some individual companies. With things like Tesla, I've talked about this in the past, but the reason I don't hold a lot of tech companies or even individual companies as it stands today is because my fiance, she holds a lot of tech companies in the individual positions. That's why I don't really cost average into the QQQ ETF, because I feel like we've already got nice exposure to a lot of the top weightings in the Qs, and that's why just over the years I've been kind of scaling out SCHD, S&P 500, just to continue to diversify our portfolios. But one company we do not hold is Tesla, and Tesla still holds a special place in my heart after I made just some wicked gains buying it in 2019. And now that it is suppressed quite a bit, I do feel like it's a good time to start cost averaging back into it. It is a very volatile company, so I'll probably take it very slowly, but you can subscribe for when I start to do that into the early next year. But I want to break down these ETFs, talk about where I think things are going. We'll talk about small caps, the Qs, VDY, the SP 500. But if you do want to support the channel and you want this spreadsheet, you like how I track my portfolio, go on over to my patron members page. The link is in the description below, where you can get access to my chat groups and get this spreadsheet. And just getting into it, what is absolutely crazy is the comparable performance of all these different ETFs in sectors. What I've kind of aligned here over the year to date is the Schwab US Dividend Equity ETF, the S&P 500's VOO. We got the Qs in here, of course, and the Russell 2000 representing these small caps, which venture capital small caps were just absolutely eviscerated over the last couple of years. And then obviously we got the Canadian markets. And what you're going to notice here is the Canadian markets, SCHD, and basically the Russell 2000 have almost been performing on similar levels. Like, it has been quite devastating for dividends in just the realm of small caps, where is the S&P 500 because of the Magnificent Seven. And then if you look at the Qs, which definitely represent the Magnificent Seven, have just absolutely propelled the markets. But there's good absolute reasoning for that. It's not just that their valuations are too overextended today, because I think the Qs now trade at like a 33 or 34 times multiple, where historically they're about 28 to 30. It just has to do with the fact that those companies have a more resilient balance sheet. I mean, they can pay their debts off. They're not inflicted by a higher interest rate environment like the rest of the market is. However, when we're talking about value today, especially if we go into an interest rate cut cycle, my bull thesis is that these companies that have been hit the hardest are going to see some of the best recoveries. But I still think you should have broad exposure to every one of these sectors. And the easiest game plan is just to buy like 4 ETFs. You could do SCHD, you could do VOO and the Qs, and just even the Russell 2000. And then as these sectors ebb and flow, just put more money in the ETFs that are performing the worst, because historically they always come back, and the ones that do the worst tend to come back with the most vengeance. But it's just wild looking at the year to date and where the best money making has really been. So I've definitely not been keeping up with the Qs. The performance, if I just kept on some of those tech companies, which again, I do not share the combined portfolio as much with the fiance side, but I will be updating a combined portfolio probably toward the end of this month into probably the end of the year, maybe sometime the beginning of December to mid-December, just to show a full year cap of mine and the fiance's portfolio within my patron members groups. So just something else for the patron members to look forward to. But take a look at this. This is where your jaw should just be hitting the floor. Crypto was the first thing to crash and should be the true sign of a bottoming, because the recovery happening here is almost jaw-dropping. Like, it is rocket ship back to the moon. No one's really gloating or crazing about this that I'm aware of. Like, the media has been very hush-hush about the crypto realm. But look at Solana. It is up 318 damn percent. Just in the last, year to date. I mean, you zoom in on the month and it's up 151 damn percent. The last month has given half of those gains. I mean, you look at the top 10 crypto holdings by market cap, and they're all excelling incredibly well. I mean, I've got some Bitcoin and Ethereum, nothing huge to any major extent to gloat about, but it's just mind-boggling to see like what's happening in the crypto space, which should show a sign that, things are perhaps starting to come back. It's a soft landing, unless I'm wrong, which we'll find out in time. And consider subscribing to see it all blow up in my face. Or maybe you're joining this fun rally and you're buying these dips like I am. But I'd love to know what you think in that comment section below.